You weren't supposed to see this happening in real time. Gold doesn't just collapse like that. Silver doesn't lose nearly half its value in days unless something underneath the entire system just snapped. And what most people are calling a normal correction was actually a signal, a controlled rupture, a wealth transfer disguised as chaos. Because when gold and silver fall this violently, it's not just a market move, it's a message. It's power shifting in silence. And if you blink, you miss who's really taking advantage of it. If you want real financial truths they don't teach, hit subscribe and turn on notifications. You don't want to miss what's coming. Because this moment right here is one of those moments history hides inside a headline, and years later people will look back and realize this was the reset point. Last week, gold was untouchable. It was breaking records. It was soaring above levels nobody thought were even realistic. Silver was acting possessed, ripping upward like it had been unplugged from reality. The media called it a safe haven rally. Analysts smiled on television. Retail investors piled in with shaky hands and wide eyes. Everyone thought they were witnessing the beginning of the next unstoppable bull cycle, a golden era, a silver supernova. But what they were actually watching was the bait. Because markets don't move on logic. They move on psychology. They move on narrative. And when a narrative gets strong enough, when enough people believe the same thing at the same time, the trap is already set. Gold didn't rise because the world suddenly discovered truth. Gold rose because fear was being monetized. Inflation headlines, war tension, trade conflict, currency decay. It all created the perfect emotional cocktail. People weren't buying gold because they loved gold. They were buying gold because they were scared of everything else. And fear is predictable. Fear is programmable. The elite understand this better than anyone. They don't trade charts. They trade human reaction. They trade panic. They trade euphoria. They trade the moment your brain stops thinking and starts chasing. And last week, the chase was everywhere. Gold smashed through the ceiling. Silver went vertical. Social media was flooded with clips screaming, "This is the end of the dollar." Crypto traders were celebrating because metals were validating the same story. Fake money is dying. Real assets are rising. But here's the first hidden truth most people never see. The higher the crowd climbs together, the thinner the floor becomes. When everyone is on the same side of the trade, the market doesn't become stronger. It becomes fragile, overcrowded, one spark away from collapse. And that spark came fast. Because while the public was watching price, institutions were watching positioning. They were watching leverage. They were watching something far more dangerous. Options. See, the rally wasn't organic. It wasn't just people buying gold bars and holding them. A massive force underneath was amplifying the move like gasoline on fire. Call options, contracts that let traders bet on gold going even higher. And when enough call options flood into the market, something weird happens. Something almost invisible to the average investor. Dealers and institutions who sell those options have to hedge, meaning they have to buy the actual asset to protect themselves. So price rises, which forces more hedging, which pushes price higher, which attracts more calls, which forces more hedging. A feedback loop, a gamma loop, a self-feeding financial engine. It looks like momentum. But it's actually pressure building inside a sealed container. And containers eventually explode. This is where the first mini cliffhanger hits. Because the rally wasn't just excitement, it was mechanical. It was engineered by structure. And once structure flips, it doesn't slow down. It snaps. And when it snaps, the fall is faster than the rise. Then came Friday. And most people will never understand how one announcement changed the entire gravitational field of the market. Donald Trump nominated Kevin Warsh as the next Federal Reserve Chair. Sounds boring, right? Just another name, another bureaucrat. But in the financial underground, this name was a detonator. Warsh is seen as orthodox, serious, hawkish on inflation, the kind of figure markets interpret as less likely to panic cut rates to save growth, less likely to flood the system with easy money. And the entire metals rally had been partially built on one assumption, that rate cuts were coming, that the Fed would go dovish, that the dollar would weaken. Gold loves a weak dollar. Gold loves falling rates. Gold loves monetary softness. So when Warsh entered the picture, markets instantly recalibrated. The fantasy cracked. The dollar surged. And gold suddenly wasn't the safe haven anymore. It was an overcrowded trade in the path of a rising currency. And that's when the first domino fell. Gold dropped nearly 9% in a single day. Not a pullback, a rupture. A confident shaking implosion. Silver didn't just drop, it got slammed. And here's where things turn darker. Because price doesn't collapse like that without force. The force was leverage. Most people don't realize how much of these markets is built on borrowed money. Futures contracts, margin positions, debt-funded exposure, traders controlling millions with a fraction of collateral. And when prices rise, leverage feels like genius. When prices fall, leverage becomes a guillotine. Then the second announcement hit. Quiet, technical, hidden inside the machinery. The Chicago Mercantile Exchange raised margin requirements. Translation? They demanded more collateral from traders holding leveraged positions, meaning anyone who was overextended suddenly had to come up with cash immediately, or liquidate. And when liquidation starts in a crowded market, it becomes forced selling. Not choice, not strategy, forced selling. This is the liquidity trap, and it is one of the most brutal mechanisms in finance because once margin calls begin, traders don't sell because they want to. They sell because they have to. And forced selling doesn't care about fundamentals. Forced selling doesn't care about long-term value. Forced selling is pure survival, and survival creates cascades. So gold dropped, which triggered liquidations, which caused more selling, which caused more margin calls, which caused more selling. And suddenly the market was no longer a market. It was a stampede in a burning hallway. Liquidity evaporated. Traders reported they couldn't even exit positions without moving the price violently. The metal became a falling knife in a vacuum. And the public watched it happen thinking, how is this possible? I thought gold was safety. That's the psychological warfare. Safety is an illusion when everyone crowds into it at the same time. The elite don't need to manipulate price directly. They manipulate positioning. They let the crowd build the tower. Then they remove one beam, and gravity does the rest. Now here comes the twist most people won't talk about. While retail investors were panicking, guess who wasn't? Central banks, institutions, the quiet accumulators. Reports surfaced that demand remains strong beneath the chaos, that China, Poland, South Korea, and others continue buying gold not as a trade, but as a reserve weapon. Because central banks don't buy for next week. They buy for the next decade. They are playing the currency debasement game at a level retail can't comprehend. They know fiat money is slowly decaying. They know debt expansion never stops. They know geopolitical risk is structural now, so while the crowd screams, they accumulate. And that's the silent wealth transfer. The public buys the top through emotion. The elite buy the crash through discipline. This is how cycles work. Asset repricing isn't random. It's staged, rally, euphoria, crowding, shock, forced liquidation, accumulation, repeat. Crypto whales understand this too. They've run the same playbook for years. Pump the narrative, trigger FOMO, let retail pile in with dopamine, then pull liquidity, flush leverage, accumulate lower. The battlefield isn't charts, it's the human nervous system. Fear and greed are the real currencies. The media amplifies it perfectly. When gold was screaming higher, headlines celebrated record highs. When it crashed, headlines screamed panic. It's narrative engineering. They don't inform you. They steer you, because the average investor doesn't buy based on value. They buy based on emotion. They buy the story. And stories are programmable. Here's the illegal feeling truth. Most people aren't trading assets. They're being traded. Their attention is being harvested. Their panic is being monetized. Their exit is someone else's entry. When you see gold collapse like this, you're not watching the death of a rally. You're watching the cleansing phase, the system shaking out weak hands, the reset before the next positioning. And the question isn't, is gold over? The question is, who used this collapse to move billions quietly? Because someone did. The trade was too crowded. And crowded trades always end the same way, with blood in the hallway and silence in the vault. So what happens next? That's where it gets even more unsettling, because if Warsh is truly hawkish, if the dollar truly strengthens, if monetary policy stays tighter than expected, then gold and silver may remain volatile. But if the dollar fades again, if Warsh signals dovish flexibility, dip buyers will return. And that's what smart money is watching. Not price, signals, liquidity cycles, institutional accumulation zones. The public thinks markets are about predicting. The elite know markets are about positioning before prediction becomes obvious. This crash wasn't an accident. It was a stress test. It exposed leverage. It exposed crowd psychology. It exposed how fast safety turns into slaughter. And it reminded everyone of the oldest rule in finance. The disciplined win, the emotional lose. So if you're watching this, understand, you just saw the system breathe. You just saw the machine flush. You just witnessed a hidden power move disguised as chaos, and most people will forget it by next week. But you won't, because now you see the pattern. Gold and silver didn't just collapse. They revealed the invisible wiring underneath global money. And once you see that wiring, you can never unsee it. The real game isn't buying assets. It's surviving psychology. It's not getting pulled into herd madness. It's understanding that every major crash is also an elite accumulation event. So here's my question for you. Do you think this was a normal correction or a deliberate liquidity trap? Drop your answer in the comments and send this to someone who needs to hear it before the next reset hits. Subscribe and turn on notifications, because what comes next in the financial storm will make this crash look like the warning shot. The market doesn't reward the loud, it rewards the aware. And now, you're aware.